Welcome to my channel, good people. Okay, now please come closer. If you are in your 20s, I mean young adult, even if you are in your 30s, let me tell you a basic reliable information. The best time to start investing is now. Like seriously, now. I mean, the earlier the better. Why? Okay, I have so many good reasons which I will discuss in this episode, so don't go away. Stay tuned for a comprehensive analysis on the subject matter. Meanwhile, this is for financial education purposes. Thank you. Grab a cuppa, of course, I mean a cup of tea, and then subscribe. Remember, our target is 500 subscribers, and for those who already subscribed, thank you. Moving on. If and when you start earlier, I mean as a young adult, your money start to compound earlier. Consequently, you will end up with more money later in your retirement years than those who start late. Okay, let's say you still don't know what type of investment I'm talking about. Well, I'm talking about stocks, bonds, index fund, and ETFs. Stay tuned. I will guide you on how to go about it. And please note, I'm not a financial analyst. Meanwhile, let me tell you the reasons why if you start as a young adult, you will end up with more money than, more than enough. Let's say you could even become a millionaire in your retirement age. Okay, now, as mentioned earlier, the first consistent and reliable reason why you should start earlier is because of the power of compounding. The great Albert Einstein once said, and I quote, "Compound interest is the eighth wonder of the world." Is it true? Yes, of course. How? You see, compounding occurs when you reinvest your earnings, and those earnings begins to work for you, earning you more money. Okay, now let me quickly show you an example before I move on. Let me grab this compound calculator. And for example, let's say your goal is to have £1 million by the time you retire at the age of 65. And let's say you are lucky to have picked a reliable stock that hence you say an annual return of 10%. And let's say you are now 23 years old. And the retirement age, remember, is 65, meaning you have 65 minus 23, which is 42 years to invest. Okay, now let us use this calculator. And for the purpose of this exercise, I'm just going to say initial deposit 500. You could put, depends on who, you could put any money, any amount, but for now, I'm putting 500. And let's say, remember, this is initial deposit. Let's say interest is 10%, as mentioned. And then remember your years, you have so many years to put money in your investment portfolio. Now, and then let's say, because you have so many years, you put 150 every month. Now, let's do the maths. Let's do the calculation and let's see what we're going to get at the end of the day. Now, wait, it's coming. It's taking its time. Give time. Voila. You see, it's over 1 million. So, you can achieve your target actually. And your total monthly deposit will be above £75,000 thereabout. And this is the breakdown. Take your time. Go and look at it later. Okay, now. This is one scenario. Let us look at another scenario. Let's say you are now 42 years old and you are to retire, remember, 65 years old. Well, you will have 65 minus 42, so you have 23 years to invest. Okay, let's change this basic year. This is 42 years at 23. Now, you just have 23 years to invest here in this case. Voila. Now, same amount, £150 every month. Initial deposit is £500 at 10%. Let's do the math. Now, let's have a look. Okay, give it time, it's coming. Great. Now, what do we have? We have 164,000. That means you can't achieve this with this amount. The only way out, let me tell you, to achieve this goal of 1 million is to aggressively put 1,000 every month. Now let's have a look. You see what I'm talking about? The earlier the better. Now let's put 1,000. We just input 1,000 now. You can now achieve it. You have just a little bit of, above £1 million, and this is your monthly contribution, and this will be the breakdown. So now contrast all the different scenarios. I'm convinced you got the picture. Moving on. Another reason is the time factor. You see, young people have time to learn and recover from losses. This metric is key. And aside from the fact that it is time is a catalyst of compounding interest, at a young age, you are more likely to make mistakes. In your investment journey. You will inevitably make some bad or stupid decisions, which will result in losses. Starting young allows you the time to withstand and recover from your losses by changing your investment strategy down the line. Another key reason is young investors can withstand more risk. Being young gives you the advantage of not having to worry about taking investment risk. Young people can be very aggressive with their portfolio. They can decide to invest in higher risk bonds that gives higher returns, because according to the risk return trade-off, a higher risk is usually linked to higher returns. When those returns are compounded over time, you'll be thanking yourself. Whereas the older you grow, the more financial commitment you'll be burdened with. This includes things like buying a house, raising your kids, paying for medical expenses for your sick parents, etc., etc. And that's the reason why other people tend to invest more in low risk assets such as fixed deposit and bonds. Okay, now another factor, key reason, is mistakes. Let's say for some reason beyond your comprehension, or your investment decision turned out to be a mistake and you lose some money. No worries. Why? Because mistakes makes you to go back to the drawing board again and recalibrate. To learn better and re-strategize. To tell you, schools or colleges don't teach financial education. And some of us learn by trial by and error. Of course, by making mistakes. Another good reason is the use of technology. You see, the use of technology among the youth is a key reason, because most of them grow in tech era, and generally speaking, younger generation tend to be considered more tech savvy than older generation. You see where I'm coming from? Okay. You see, younger generation search for any investment related topic on the internet. They can use the internet to do that. They can find the answer and learn quickly with the net. And now we have several online platforms like Trading 212, Free Trade, Charles Schwab's, etc., etc., where they can use it to begin their investment journey without any brokerage charging them higher fees. Meaning they can now invest in things like S&P 500 index fund. They can invest in real estate trust, which is the REITs. They can invest using the robo advisors, buy fractional shares of stock or ETFs, etc., etc. Meanwhile, I know picking individual stocks could be overwhelming. Why? Because there are thousands of stocks out there. However, I have a solution. I have a better option, which is the index fund or ETFs. Please check my video on this financial instrument. You will see them at the end of the clip. Nonetheless, let me tell you about index fund. What is index fund? Okay, simple terms. Index fund is a combination of several stocks within a fund. So if and when you buy an index fund, you are investing in all the companies within the fund. You see, you can't get it wrong with index fund. Why? Because they are relatively low risk option for investing in stocks and bonds, designed for steady long-term growth. And for instance, if 2 or 3 stocks within the fund did not perform better, other stocks within the basket will usually perform better to cover the losses. So as a teenager or young man, I think the best way to kickstart your investment journey is to invest in index fund. Some fund and learn the skill of the skill. Choosing a company based on fundamentals. Start with index fund. That's what I'm trying to say. Then learn the skills. Choosing a fundamental company. What do I mean? Remember, fundamental means you would and should be looking at the company records and see, okay, if the company has consistent growth in sales and revenue with cash flow from operation and net income consistent over the year. Let me repeat that. Fundamentals. How do you assess a company? You assess a company fundamentals by looking at their records. You look if they have consistent growth in sales and revenue with cash flow from an operation, meaning net income consistent over the years. And to inform you, some funds give an annual return of say 9 to 10%. Check my videos on index fund for more details. Any question, please drop them in the comment section. Okay, now here comes the best part. Remember, our target is 500 subscribers. For those who already subscribed, thanks a million. The goal is to generate wealth, build companies, and then create jobs. Bye now. See you soon.